Today, I'm joined by Dr. Yoong and Freddy Lim. Dr. Yoong is a senior economist at the University of Southern California, where she directs the offices of the USC Center for Economic and Social Research in Singapore, as well as Washington, D.C. She's also a principal member of the USC Behavioral Economics Studio. In this episode, they tackle various financial and investing biases that investors fall prey to. We also get insights on what we as investors can do to identify them and use them towards our advantage. I hope you enjoy it, and if you do, be sure to subscribe and consider leaving us a review and sharing it with your friends. Welcome to another episode of In Your Best Interest, your personal finance podcast. I'm your host, Philipp Müller, and today we will be chatting about the field of behavioral finance. One of the many reasons we started the podcast was to bring you insights to managing personal finances, and today we will cover how investors can identify patterns in their behavior that might be detrimental to their goals and use those insights to make better financial decisions. For this, I have two phenomenal guests on the show. One is the CIO and co-founder of StashAway, Freddy Lim, and the other is Dr. Yoong. Dr. Yoong is an applied economist working at the intersection of behavioral economics and health and financial decision-making for the well-being of vulnerable populations. Dr. Yoong's primary appointment is a senior economist at the University of Southern California, where she directs the offices of the USC Center of Economic and Social Research in Singapore and Washington, D.C. And she's also a principal member of the USC Behavioral Economics Studio. Based in Singapore, Dr. Yoong also holds faculty appointments at the Yong Lin School of Medicine at the National University of Singapore, the London School of Hygiene and Tropical Medicine, Singapore Management University, and the RAND Corporation. She's the author of over 70 peer-reviewed articles in leading economics, medical, and public health journals. In addition to her academic work, Dr. Yoong is the founder of Research for Impact, a Singapore-based social enterprise working to make behavioral and social science research accessible, inclusive, and transformative for everyone. Dr. Yoong received her PhD in economics at Stanford University as an FSI Star Foundation Fellow after an early career in financial services, and her AB summa cum laude in economics and applied and computational mathematics from Princeton University. Thank you both so much for being here today. Impressive resume, Dr. Yoong.
Oh, thank you.
Very, very, very impressive resume. And before we get started on the topic, Jen, we always like to ask our first-time guests some personal questions. So I leave Freddy on the side for a little bit longer, just to get to know you a bit better, and for the audience to find out a little bit more. And we usually start by going back a little bit in life and see, where did you grow up? Like, what kind of shaped you to becoming, receiving a PhD in economics, and what kind of was that like growing up for you?
Yeah, thanks so much for having me. So I was born quite a number of years ago in Malaysia, and I grew up actually in Kuala Lumpur in a family of three sisters. My parents were both physicians, and we were the kind of Chinese family where everyone is actually a physician, and if you're very, very artistic, maybe you could be a lawyer. And so from a very early age, I think I grew up thinking to myself, what actually is it about people's behavior and what is it about people's choices that shape the way that we see the world and how we progress in the world? I enjoyed reading. I enjoyed thinking about the way that interactions sort of happened in the world around me. But I would say that at that point in time, I had no real concept of what it meant to work in financial services or behavioral science. It was a very traditional, if you will, childhood with a very traditional set of outcomes that we were all headed towards. What changed my own life is that I actually came to Singapore to do my high school education at the age of 15, and I decided at that time to sort of start exploring a little bit more of the arts and the humanities, and so I made the transition from science to arts, and here I was very fortunate to have a great, I think, experience in what we call the humanities program with a number of really exciting classmates, and more importantly, I worked with a group of teachers who told me at the time that I could aspire to go overseas. And so it was very interesting for me because, again, I was on a very traditional track. I had a very one-track mind about what I could do and what I could achieve, and it looked just like everything else in my family, my father, my mother, my grandma, my grandpa, my sister, my brother-in-law, all going into medicine. So at that time, I began thinking, in actual fact, it's really interesting because the division between science and arts is not so rigid, and in actual fact, drawing on different disciplines is actually something that I could do. And one of the areas where I thought, in actual fact, I see science and art coming together very cleanly in a very interesting way is economics. And so I managed to go overseas, again, with the support of people in my immediate social network. And I graduated from Princeton in a year quite long ago in economics and applied math, because I still had that Asian feeling that if you don't do math, the world will end.
Yes.
And
it's kind of interesting, actually, because Freddy almost had kind of the same background. Born in Malaysia, came also here for high school.
You worry about jobs prospect, right? So the math thing comes in handy.
Yes.
Yeah. Right. And to do economics and mathematics, coming from a background which is very medical, it's sort of a raging liberal, education as it was. And so I got my first job at Goldman Sachs and Company, and I worked in the fixed income division.
Was that in the US?
In the US, yes. In New York, I worked in New York. I was privileged enough to also go to London and then come back to New York and end up working in credit derivatives. And it was very exciting for me, again, coming from my household background, because my mother is like, what is this? What is this bank? Are you a teller? The concept of investment banking, again, for my family was very strange. So for me, it was all new and exciting, and I was able to work in a nice group in credit derivatives research with a lot of very cerebral and intelligent physics PhDs, people who were designing extremely complex projects for very unique markets in the reinsurance and insurance world. And at the same time, I could see just below on the trading floor the heights of exciting and irrational personal behavior, like every day. And it was an incredible bit. I enjoyed my time at Goldman tremendously. And what caused me to shift my perception was basically September 11th. On September 11th, I was on my way to work. As usual, being Malaysian, I was a little bit late. And I was stuck on the subway for several hours. And when I came out, the world had transformed. And I thought about my priorities, and I thought about what I wanted to do. And as I said, even though I had a wonderful experience at Goldman, I thought, what I'd really like to do is sort of try to understand finance from a more human perspective. And I had sort of a small midlife crisis right there. Then I did my PhD in development economics, to think about finance. And at that time, working in the social sector, it became clear to me that the behavior that we wanted to see on Wall Street did not actually, in my experience, follow the theories that I was seeing when I was an undergraduate. And the experiences of what I had seen in the social sector, people with very good intentions, was also not following any of the theories that I read about and tried to implement in my PhD. And at that moment in time, again, this was far enough back that behavioral economics was not a standard part of the curriculum. It became very clear to me that these traditional economic models that I had been studying now for about 10 years, both as an undergraduate and graduate student, really had something very wrong with them. And that both people who are very sophisticated in the financial world, but also people who are very well-meaning in the social service world, were not getting things right, not because they did not want to do the best thing for others and themselves, but because these traditional models were falling short in very fundamental ways. And that really has set my research trajectory ever since.
Into the economic, that's super, super interesting background, I think. And you explained perfectly how you navigate around it. Not everything is always a straight line, right?
No.
Absolutely not. So with your first job, though, at Goldman, I have to ask, we always ask every guest, what did you spend it on?
What did I spend my first bonus on? I think that
paycheck.
My first paycheck. So my signing bonus came before my paycheck. So I often think of the first money that I came from Goldman. What did I spend it on? I put it right into my savings account. I was not very imaginative.
Yeah, no, very good answer.
And then I bought a suit.
That's the best answer I have heard so far. You don't spend it, you reinvest it.
That's correct.
The suit is investment.
Reinvestment, exactly right, as well. Yeah. Good. No, thank you so much for setting the stage here. And I think this really, brings us to the topic, right? And I think behavioral finance, I always thought was a super, super interesting topic. The company I worked for before, Fisher Investments, Ken Fisher, is very big on behavioral finance and, trying to understand it better to be a better investor, make better decisions for clients. And also understanding clients' background, right? When they come calling and wanting to liquidate portfolios at the worst possible time, right? So with that being said, maybe you can give us a little bit of a background of, how do you know how behavioral finance became a field even, and like kind of like what it encompasses more from a high level before we go deeper into each one of those topics?
Right. So behavioral finance, I think, and if I even take a step back, right, to think about behavioral economics in general as a field, is really sort of the evolution, I think, of economic thinking to take into account these insights that we have from behavioral science, cognitive science, and psychology. And where I think it really actually sort of melds the two things together is that it takes sort of the traditional economic frameworks that we have about choice and decision making, about preferences, information, and constraint optimization, and tries to marry that very systematically with the insights that we have from how people actually make decisions. And so, for example, what it does is if we think about people's preferences over time, instead of assuming that we have an exponential time discount factor, the way that we might see in a cash flow model or an accounting model, it really tries to ask us, from the point of view of what we know from cognitive science and in fact the actual physical structures of the brain, how do people really think about time? And what we begin to understand from that is that in fact people's preferences are hyperbolic. When we think about the present day, we have a much stronger tendency towards impatience than we do when we think about the long term, simply because we think about it with a different part of the brain. And so when we marry this insight, which you see in behavioral science, to the economic models that we have, then we have new financial models that actually do better at, first of all, predicting behavior in a more systematic way and actually are more robust. And so it's not simply sort of saying we have these insights about how people behave, but actually sort of incorporating them together with traditional economic models and making them more robust, more predictive, more useful. It's about saying that we are acknowledging that we have irrationalities and deviations, but not in an unsystematic, random way. Right? So trying to make sense of the world in a more holistic and complete manner. And so that's, I think, the evolution of behavioral finance. We've seen this happen at the household finance level. In the last 10 to 15 years, we've also seen behavioral corporate finance, where we've had researchers like Ulrike Melmendier try to incorporate these insights into corporate behavior at a higher level, not just in the financial markets and investor behavior itself. So I think it's a very natural evolution of the kind of work we had seen before, looking at phenomena like asset bubbles and herd behavior, but really trying to strengthen this with core learning from other disciplines.
Yeah, no, I absolutely agree. And I think that was a really good introduction to behavioral finance, what it is now. You mentioned earlier on that you got interested in it when you were speaking, when you were working at Goldman Sachs, right? You were looking down at the trading floor and it was craziness, right? Freddie, you've been on a trading floor. You worked at different investment banking jobs. How do you... Well, first of all, have you ever thought much about behavioral finance? And then also, what was your experience, being on the trading floor, and can you, see her point of view when she was looking down, kind of like, hey, what's going on there?
First of all, I feel like I'm the lab rat because back then I'm on the trading floor. I don't think about it, but someone like Joanne looking down on us, thinking about the rats, how are they behaving? So good way to go, Joanne. No, back then, the classic economic theories were rational expectations. And that was seen, I think if I put the time back, late 90s, we're talking about all the latest development in the 80s, right, with a lag. And rational expectations, like the heavy hitters like Thomas Sargent and the likes, they really big on model elegance. Mathematical elegance, no arbitrage, and everybody makes optimized decisions, right? That's what they assume, and that was mainstream. Nobody talks about irrational behavior as part of the model, right? And so for Joanne to sort of be ahead of the times and just sort of look ahead, I think that's very progressive. But that was not mainstream back then. It's easy to say today. It's not easy back then.
Yeah, no, that's exactly right.
So that's me looking back.
Because now it's becoming almost quite normal to, every investment bank or like trading floor probably has someone looking at this and helping people understand, their decision better, and like there's models to safeguard certain things, right?
Well, yes, and in fact, I think Steve Wendell from Morningstar, which has also been a large sort of practice figure in the field, has actually been spearheading a survey now, which shows that there are over 80, I think, and growing number of behavioral science units, not just in the financial services sector, but really everywhere.
Yeah,
I mean, there are hedge funds companies that started getting experts into the firm and observing the behavior of employees and trying to understand people's behavior biases. And behavior biases is, as we bring it back to investments, behavior biases day to day, we've seen it everywhere, every single day of our life at StashAway.
Yeah, no, we absolutely do, and right. And before I actually want to get into the question of how can the understanding of behavioral finance help people achieve their long-term investing goals. And you already said, short-term versus long-term, there's some difference between this, right? Let's go first, though, backwards and say, explain actually some biases that are out there that people might have heard of, right? That might potentially hurt them. What can they do about each one of those, right? So I think one of the big ones, of course, is also pretty popular in every country is the home country bias, right? You get it all the time. Hey, why don't I have, first time when I look at portfolios of people, they come, hey, can you do a portfolio review? It doesn't matter which country you're from. In that country, you will have an overweight to your home country, right? German people will have, 70, 80% Germany, right? US has almost close to 100% usually US holdings, right? Same here. Always ask about, Singapore heavy portfolios, right? If you're from Singapore, because you think you know these companies, right?
Yeah.
So can you both maybe give your 2 cents on home country bias and what you suggest people do about that?
Yeah, I think there's many reasons why we actually see home country bias, right? First of all, people have very limited attention, so they sort of focus on what they know. It's quite natural for them. The other reason, I think, is that people have a little bit of an endowment effect when they feel that something belongs to them or they have some sense of ownership. Then they tend to feel that, right, there's a little bit more value there than something that they don't know. Sometimes there are halo effects where because people think that their country, they feel very strongly about their country in one regard, that this somehow spills over to other sort of things that are not necessarily related. Sometimes people feel a little overconfident because they feel overconfident or over-optimistic about things that are close to them or that they identify with. And so for all of these reasons, we actually see home country bias quite strongly, in not just in finance, but in all kinds of other settings as well. And part of what is actually very important is that for people to understand or have a systematic way to overcome this or to be offered other options as a matter of course and not to allow people to simply default into a portfolio because that's what they know and feel comfortable with.
I guess there's also a fear of having currency risk, and that fear is not well understood, right? Because anything non-Singapore dollars, for example, people would think of it as, it's risky. I should always be at home. What they didn't know was...
That's how you pay, right?
Yes.
Yeah.
But what people did not think about is, hey, maybe some currencies are safe haven. And if I have some of them and in very bad times for markets, it actually reduces my risk. And in Sing terms, my return actually would be more enhanced with a systemic market meltdown. We've seen it during COVID. Dollar, Japanese yuan, Swiss franc, they outperform even the Sing dollars. We've seen it in 2008 financial crises. Every time it happens. So people just need to sort of, I don't know, this is a tough one because we view it as a way to reduce risk in the extreme, but most people are brought up to think of currency as a speculative component, as something to be feared of, as something to get rid of, right? So in this case, I wouldn't say it's because of your surrounding, but it's also because of your upbringing and how you have been educated over the years. That's one angle to add to Joanne's angle.
Yeah. And for the investor, what do you suggest they should do? Let's say they have a big portfolio, right? Or like a portfolio and like 75+% is probably...
And it should always be very diversified, but you need to think about having sufficient amount of funding and safe haven currencies in your portfolio because these are the one that gives you portfolio insurance when times are tough. And you also need to know where your country stands. If you're Brazil or some emerging countries, your country belongs to a more aggressive currencies. When times are bad, you're going to suffer. But so when you have enough yen and franc and dollars, it does help you back home. But Singapore is sort of in the middle. It's a high-end currencies, right? But it's not all the way up there like the yen and Swiss franc. So you're just going to know where your country stands in terms of its market status, and then make an adjustment for that, right?
Yeah, no, absolutely. And another one that Joanne brought up before the podcast, actually, one of her favorite ones, is actually loss aversion bias, right?
Yeah.
You want to go ahead and maybe explain that a little bit, and also then we can go through the same kind of steps of how to take action and get rid of it.
Sure. So loss aversion is a little bit related to sort of the fundamental work of prospect theory. Some of you may have heard that term. But sort of at a high level, all it means basically is that when we experience, say, a gain, we don't get as much utility out of an equivalent gain as we lose if we lose an equivalent amount of money. So we feel losses several times more than we experience joy from a gain. And so we're much more sensitive to loss. And part of that at an extreme is partly because also the at the end of the day, what that does for us is that it makes us more risk averse when we think about losing, or when in fact losses are framed to us in a more salient way than our gains. Right? So when we are more aware of the losses, or when things are couched to us in loss terms. And so that has several implications for us. It means that, for example, when the market is very volatile, people are very likely to sell off very quickly. But when we have a market recovery, because it's going to take investors much more time to recover confidence. So the market needs to go up and up before people come back in. And then what that means is that we tend to panic sell, and then we wait too long and we're not able to recover any of that going up if we rely on our instincts. The other problems that happen with loss aversion is that it manifests in many other ways as well. So we are very regret averse. Sometimes when we look into the future, the prospect of future gains means that future losses makes us very risk averse. Some people have what we call zero risk bias. They don't want to take an action in the future if they can envision any loss. So it distorts their risk preferences. It also means that occasionally when we've already incurred losses, we're very wedded to those losses in the past. So we're tied to our sunk costs. All we can think about is the cost that we've already incurred, and we're very concerned about that. And so in general, I think loss aversion, because we have this asymmetric treatment of wins and losses, it means that when we truly face a portfolio, especially in a period of high volatility, it becomes really difficult for us to manage that objectively.
Yeah, and I think this is one of my favorite ones because it can really destroy your financial plans, right? Or if you take this back to personal finance, right? Loss aversion is something that can really destroy all you're working for all your life, right? If you get out at the wrong time, you don't get back in at the right time, even though you should have maybe just stayed in the market, right? So, Freddy, you and I, we talk about this a lot on our YouTube channel as well, right? But it has to be said again, because I think this is where people, make or break their retirement sometimes, right? And it's sad to see, but it is, like you said, it comes from a quite scientific standpoint why it happens. It happens, but what can people do?
I mean, it hit the nails here, because if you talk to those people, they will always tell you they want to buy low, sell high. But in reality, completely the opposite, because of the loss aversion and thing. And sometimes one loss aversion led to a memory or trauma, and they will never get back to the market. Can you imagine when you cut at the low and the market bounce back? There's no way the same person is going to get into the market again. And we've seen that in 2008 crisis, and in the 10-year bull run after, a lot of people just never got back in. And that's a lot of opportunity cost for not sticking to your investment plans, right? I think that behavior bias can be addressed with a solid plan, where you first before you invest, you plan the right amount of cash that you should have, right? So that you don't sell your portfolio on the low because you need the money. So that is not perfect solution, but it sort of reduces your tendencies to sell the low, right? And two, maybe it's a StashAway thing, but we tend to talk about stress testing rather than back testing. So we tend to like to look at stress scenario and look at the historically most painful scenarios and say, well, this is actually your risk estimates from us. Mm-hmm. And as long as this number is realistic for a crisis, that's when it matters, right? When a crisis happens is when those risk number really need to be holding. But most financial models make it worse, because it's just based on some arbitrary window, based on some time period, that's good times. You always underestimated the true risks of your investments. We prefer to take the stress testing approach and then at least if 2008 happens, or if COVID-19 market rout happens again, you're mentally prepared right away for a much bigger loss. And you ask yourself before you invest, is that the right amount of risk for me? If it's not, face the reality, face the fact, reduce your risk level, right? So those are mitigation techniques, but they're not solutions. They're not perfect solutions.
But there are some solutions here given from a scientific standpoint. Then, Joanne, is there anything that you add on how you can manage this better?
No, I would add to that's absolutely right. So we talk about sort of the commitment device, right, and having people sort of focus on the long term. We also talk about not helping people to sort of not follow the day-to-day fluctuation of the market, but really focus on periodic updates, so that at the end of the day, they don't feel that volatility. They have a long-term goal, they stick to it, and they have a strategy and they stick to it. So to think about the strategy and not to be swayed by the day-to-day outcome, particularly in volatile markets. I think those are all very sensible things to do.
Unfortunately, we're in an age of apps and real-time updates.
Right.
So it goes double-edged in this case.
It really does.
No, absolutely. And I want to get actually into social media a little bit later, but we're getting there soon, but that makes perfect sense. You already mentioned sunk cost earlier. Mm-hmm. There is something called a sunk cost fallacy. Mm-hmm. Would you like to explain that a little bit more?
Yeah. So the sunk cost fallacy basically means that what has happened is that we have invested something in the past, or we've put something in the past, and even though it doesn't affect the prospective outcome going forward, we are committed to that path because we consider the cost that we've already spent. And what that means is that people find it very hard to cut their losses and move on. And they also feel that a course of action that they've invested a lot of time in, or a lot of effort in, or a lot of energy in it, they just want to see it through. So if you ask people even, right, you have a project, you know that the project is almost done. If you tell them that it's 90% done but sure to fail, they're much more likely to say, well, I just want to finish this off, right? Then if not. And it's not just financial cost, it's emotional cost as well. Time cost, emotional cost. People feel committed to a path of action because of the past, rather than objectively, prospectively looking at the cost and benefits going forward. So people really get trapped into a course of action because of what's happened before.
They fell in love with a particular investment.
Yes.
And it's easy, right? You to fall into that, right? You spend a lot of time researching a particular company, disruptive technologies, or Bitcoin, or blockchain, what have you. You get married to the idea that this is profound, but what's often hard for the investors to decipher is that how much of what you have researched is already in the information contained by the prices in the markets, and are you really taking a forward-looking approach where you have an edge, right? So, but without going to that direction, I would say it's because you have put in so much work and effort, and perhaps you're holding on to it. You probably wouldn't take losses as quickly as you would should have. You get married to it, and you stay longer into the losing investments. So that we see happens all the time. I don't know if that resonates to the same concept.
No, absolutely. And the more you spend, the more you've invested in it, the more, all else equal, the more committed you are to giving it another chance. And that's very tragic because it's hard for people to be forward-looking, as you say, in the face of all the evidence.
Yeah, especially like Freddy mentioned, the being married to a stock or an ETF that you bought, right? That might have sounded good at the time, but now it's deep in the red. So for people, it's easier to say, hey, I'll sell it when it's back to break even, right? Than actually selling it at a loss, right? Because exactly that reason. So this we see this quite a bit, right? So if the market is down, at the point when customers see it's green again or back to zero, they're like, oh, now I can sell because now I made it through, right? Now I'm back to, I haven't lost anything.
No, exactly. And then they have this arbitrary fixation point, which is the purchase price. And so everything is measured relative to the loss that's taken compared to the purchase price.
And in the end, the result being you're taking all that volatile swings and just to break even and you want to get out. You have enough mental trauma and you want to get out. So this is one of the cases. There's some other cases where when they're down quickly, they just cut their losses all the time and then they miss the rebound. There's one case that we talked about earlier. But this case is more sunk and you get committed, right? So both cases can happen to people in different situations.
No, absolutely. The other one, before I had some questions outside of the different biases, is the recency bias. I think that's a great one to understand for investors, especially it goes both ways from, you have a recent event that happened and you're fixating on this, or you get away. I think 2008 happened for a lot of people, or younger people kind of remember, but not really by now, right? So everyone say, oh, nothing can happen to us, right? So this year was a kind of a wake-up call for everyone, right? Especially the March period, right? Joanne, do you want to explain a little bit about recency bias and how you see it from a scientific point of view?
Yeah, so I'll talk just basically, I think it's all comes back to the idea of limited attention. There's only a limited amount of information that at any one time we can keep in our working memory, really. So the amount of attention that we have for something complex or complicated, number one, inherently is limited by our cognitive capacity. So we have, number one, a bandwidth constraint. Number two, what stays with us is also fairly determined by a number of factors. So what we know is that you experience the world, but what stays with you or stays in your, what we call your crystallized sort of intelligence, is really what either emotionally resonates with you or really just something in a very recent window. And so we can have, as an individual or even as a community, a long collective experience, but what actually stays with us in our actual tangible memory and that we act on is actually a very limited amount of information. And so the recency bias means that, right, if only events that are very salient, very recent, or very some also exacerbated by things like the emotionality of it, the vividness of it, the specificity of it, our ability to identify it with our immediate surroundings, all of these things combined together make an event more memorable and disproportionately affects our decision making. So not just the time dimension, but some of these other dimensions as well.
Well, if you take a huge pain in the markets and it's recent, it tends to take you a lot of time before you dare to get back to the market again, right? So we see that a lot. But there's also the other way where people felt like they did some research into all sorts of fancy tech names, for example, right? And it worked. And they have this recency bias as well where I'm a great investor. Wow, I'm a great stock picker. I can do this all day long. And they started becoming a little complacent. So that's the other situation, right? And a lot of people don't question their performance versus the market. So how much of the return you're getting purely from your stock picking skills? Or is it from the market going up in general anyway? Right. How many % of it is truly attributed to your work?
Yeah, and this is something we call fundamental attribution error. Right? When something goes up very positively, I tend to take that information and attribute it to myself. But if things start going really bad, then suddenly it's the market. Right? And if I do really well, I'm amazing. And if others do really well, they are so lucky. So what that means is that we all rewrite our history, right? And we rewrite luck as skill when it's going in our way, and we rewrite our incompetence as bad luck when it's going in the other direction.
No, absolutely. And one of the things that that just came to my mind while you were speaking about that bias right now is the other one that's very interesting is the confirmation bias, right? Because I think all of us look for confirmation. It's not just investments, right? In general in life, you always look for confirmation. Am I doing something correctly, right? You always look for people to tell you, yes, you are right? And for investing and for your long-term investments, it's quite dangerous, right? Because if you only look for, especially with social media today or like any kind of news is instant, you can, if you search for something in a certain way, you will get that information, right?
You will find it, yeah. Exactly.
So how do people deal with this nowadays? This confirmation bias that you get what you ask for. How can people sort through this to not upset their personal finances and their personal financial plan?
Yeah, so this I think is actually very challenging at an individual level. I think this is something where in actual fact the onus actually is on sources of information and trust to sort of create these sources that people believe in, because I think as an individual it's actually very difficult for us to sort of ask ourselves these questions. And so the creation of trusted information providers, I think, and trusted intermediaries is going to take huge prominence here.
Yeah, I mean, in the age of social trading platforms or people sharing their trade tips and they have a huge following, and I find that particularly dangerous because you are sort of leaving the responsibility of your investment to someone else. Now you're following them blindly because you feel attached to them.
Right.
But the right thing is I think the professional investors, they are trained differently. And it took years of training, right? In my case, when our seniors used to always tell us, before you talk to anyone or read anything, you got to do your own analysis. If it's data driven, the better it is. But you got to do your own analysis before you are ready to go and accept outside information. You also, when you get out there, you can't just be seeking confirmation. You got to look for differences in opinions and risk scenarios that you're not thinking about, the outside the box thinking. But that's really, really tough. It takes so many years of training and discipline for anyone in the profession to even get there, right? So in the retail space, it is made worse by social media, social trading platforms, and followings.
Yeah, no, I completely agree. I think there's a couple of other biases here that I think makes it very challenging for the retail investor. One is that we like consistency. So we like for a narrative to be consistent. So when we don't know much about something, we say, oh, it makes sense. And we don't think, is it true? But we think, does it make sense? So if it all hangs together in a way that's consistent, we like to go with that. The other thing is that we like simple narratives. So if someone can tell you a simple story that seems to make sense against a marketplace that's complex, conflicting, and to which they're actually true unknowables, that's going to appeal to you very strongly. And the second thing is that your perception of risk is again very driven by availability bias. So if you can think of something very easily, you're going to think that that's something that's more likely to happen. So when you're on social media, it doesn't matter if someone's giving you great objective market advice that's driven by data, statistics, and charts. But if you see that your friend's uncle's brother-in-law has now made a killing on something, I don't know, has managed to buy some bizarre stock in some days and has made X number of months return in a short time, that's going to resonate on some primal level much more strongly with you than these things that you don't relate to and you can't think about easily. You're going to think that the likelihood of that is much higher because that information is very easily available to you.
I also think that sort of form a peer pressure where it sort of create a bit of a FOMO. Fear of missing out, right? If everybody you know or the platform you follow, people are making a killing in certain things and you are not in the game, you sort of felt left out. And that's precisely the worst situation because by the time you get in on belated information, you're probably the last few people in the room to do so. And hence, it does hurt you later on.
No, and I think this is a very important topic, I think, nowadays because I get, people know that I'm in the financial world and we do personal finances. Friends, family from all over the place, they always come to me and say, hey, look, I found one of my friends, he's doing currency trading and he has some kind of system and it never loses, right? You always but it's happening, right? Especially like over the last year, I think it's coming up. It was the Bitcoin thing for a few years, then a year of nothing. And now it's starting to come back with like the social trading platforms like a Robinhood. It's easy to get in, right? It's easy to, and they show you all these nice graphs, right? And everyone is buying Tesla, right? Everyone is buying certain things.
Yeah. And you got all the kids on TikTok.
Well, exactly, right? But I'm always amazed that actually these people can give advice because, Freddy and myself, we have to be licensed and regulated and we have to do continuing education, right? And if we say something wrong at a seminar, we get in trouble. But
that's right.
I think this needs to be a little bit more probably over time regulated because there's everyone can give advice now, right, on what to buy.
No, that's right. And I would say that at the end of the day, and I want to make a pitch for just sort of good old investment education and financial literacy and also, mathematics. I mean, some of these are core skills that I think people go out into the world without these very core skills. And at the end of the day, you can't nudge away the fact that someone doesn't understand mathematics. That's very challenging. So we really have to do both things. We have to think about these core skills and think about the way that we're sort of what are we teaching in economics courses? What are we teaching with personal finance courses? So that people have some understanding of at least what they don't understand.
No, absolutely. But what would you say then to people who, like I just said, friends asking, right? Look, my friend is making a killing. He's been doing currency trading. He has some kind of bot or something that tells him when to buy and sell, and they never lose. Because I always try to tell them, hey, look, first of all, do some research. It probably is not going to be. It's not true, and he will have losses as well, right? There's no free lunch. Otherwise, everyone would do it. That's what I always try to tell them. But like you said, it's a primal instinct. People see like money, and it's easy money, right? But easy money always comes with dangers. That's what I believe in, because ultimately you see something happening. But how do you, both of you, like, how can people tackle that problem? Because I think it's, like you said, it's so prominent. You follow a few people on Twitter, you follow a few people on these trading platforms, right? And
no, ever since I stopped working in investment banking, everyone in my family is like, you obviously make poor financial decisions, so nobody asks me these questions anymore. But I would say exactly that response is that, if it's too good to be true, it probably is too good to be true.
Well, I think investors just need to ask certain basic questions, right? Like, how long has the other side been operating? Do you have a track record? And can you show me account statements? And then you start realizing like the cat is out. Oh, this is only last 3 months you started. Oh, the rest are back tests. And you got to start thinking, and then you start asking questions about how do you manage risk, and you got to start being interested in what you invest in and ask the right questions, right? And at least the basics, like, where's the money held? Is it in a safe place, like a bank or custodian bank, or is it with some unreliable places? And don't even get into any schemes where the custody of the money is unclear, right? So I think investors really has to just step back and ask the absolute basic questions.
Yeah.
We owe it to ourselves.
No, absolutely. Interesting topic, because it's just trending this year for sure, right?
For sure.
With all the, people like thinking this is, drove up tech stocks, right? Or like Tesla, and, it was very polarizing. So thank you both for, giving your 2 cents on this.
Rubber glove company in Malaysia, or vaccine companies next.
Yeah, exactly. What's next, right? But there's always a next. So I think people just need to peel back the onion a little bit, right? And understand a little bit more what they're getting into, and not always believe just the wins. There's also losses most people have throughout the years.
Yeah. I think there's also this, the problem I think is that we've also managed to sort of tell people at the same time that finance is very complex, but we also have to give this message that there are basic questions and basic things that everyone can know and understand, and at least feel in control of some basic strategies and basic information. So on the one hand, I think we have done a little bit of a disservice to people by making them feel that finance is so overwhelming, so challenging, so difficult, no pattern, nothing. Jargonized. And so people are turned away from it, and then they again seek the simplicity, they seek the people that they can understand and relate to, and that can lead actually to very challenging circumstances. So we ourselves, I think, as an industry have sort of done this.
Yes, absolutely. And there's 2 more questions I want to get to. The first one is there some behavioral biases between men and women when it comes to investing? And we have both men and women here today, and I wanted to hear from you a little bit. Is there some? If there are, can we learn from each other?
Wait a minute. I do have some biased opinion here.
Oh, go for it, Freddy.
Because I do believe that, according to my years of observation now, right, the trading floor used to be dominated by men, okay? And I've seen how hormonal imbalance leads to bad decisions. And I am telling you today, in my personal opinion, women makes better chief investment officers than men. Period.
All right, we have to switch at StashAway then.
Well,
but at least first stage is actually recognizing that, right? So it's actually good first step here.
And I would say that part of the problem is that we used to have such little representation that we couldn't do statistical studies because we didn't have enough male and female traders to make comparison between. So I want to say that gender is a very challenging construct, obviously, and it's also socially mediated in many countries. So that's the academic disclaimer that must always be said. But what we do see is differences in economic behavior between men and women. We've seen traditionally that in studies in the past that women tend to be a little bit more risk averse, number one. They tend to be slightly less overconfident. So in some of the studies that we've seen of risk taking, that women tend to be less overconfident and therefore tend to be, when they manage their portfolios, I think we've seen in a large study, I believe from Fidelity, if I'm not mistaken, that men tend to trade more frequently. And as a result, sometimes in that case, if they don't pay attention to fees, women who hold steady at the end of the day do better with their portfolios because they hold steady. We've also seen in other studies, I think again, not in finance, but in other fields like medicine, where we see that men are, and I say this with great love, more prone to things like decision fatigue. So women physicians, actually, when we look at physicians in emergency rooms, we see that actually male doctors, when they come in, do very, very well when they start the shift, but then there's a very sharp gradient of decline. Whereas women doctors come in, and it's a straight line. They just perform straight. So there's a little bit more of a endurance to it. And I will also say that if you follow long-distance endurance running, we're actually starting to see that women perform well in long-distance endurance feats.
I personally think this is the most critical bit of being an investment professional. It's a marathon. You require consistent decision-making over time. And that's why I maintain that a lot of women make better investment decisions. I mean, we do find them harder to get, like when you pitch to women investors, they don't get excited as fast. It's harder to get them to do anything. But we tend to find that once they have studied the problem and they commit to a plan, they are persistent, they are consistent. They stick to the financial plans. Whereas men, if I'm biased, but disclaimer, a lot of people I know who are men, they can deviate from their financial plans quite a bit. Yeah. Find some new love in security or another company, they would just jump into it, right?
Yeah. Oh, absolutely. I think I saw this as well when you have personal finance clients when I was back in the US and was managing families' monies, right? It was the best thing you can do is actually get the wife on your side, because this is the harder sell, but she will make sure that the personal finances are stick to every month, right? Mm-hmm. It's a budget. It's, we're investing every month, right? We're not buying this stock that I don't even know about, right? So I think I saw that's firsthand there.
Yeah. So there's, I think, apart from the actual equipment, I think there are very reputable studies looking at testosterone and what that does for trading behavior. I think, however, for women, what we do acknowledge is that in the population, we see lower levels of financial literacy for women, especially in societies where women are not so exposed to the financial markets. We do have a lot of underconfidence on the part of women. Maybe you could say it's overconfidence on the part of men, but we also see underconfidence on the part of women, which makes them unnecessarily risk-averse sometimes. We see that in situations, and I know we're all now in the COVID-19 pandemic, in very unequal societies, what we see is that women are carrying a lot of mental load from other tasks. And so when it comes to focusing on the long term, what we know is that when we are in a situation of cognitive scarcity, when there's a lot of other things going on in the mind, it's hard to think for the long term. And so a woman in these situations may not be as able to focus or think about the long term. And indeed, when we see surveys of financial behavior, lots and lots of women say that they manage the day-to-day budget of the household. They're perfectly good in terms of making decisions over financial products. But when it comes to long-term financial planning, very often, for whatever reason, that's the man's sphere. So there's actually many reasons there, in addition to sort of like the basic biological makeup, but sociological reasons and sort of expectations-oriented reasons that create some of these differences for women in investing. And I think growing women as an investment community is something that I'm actually very passionate about. That's
great. And I think there was some really good points on this. And I think now, hopefully, a lot of if you listen to us as a family, or, you're in a relationship, I think, sharing and talking about personal finance is very, very important. And finding out who does what best is also great, right? So you can use the best of both sides to achieve your goals. So to wrap it up then, I wanted to ask my last question. I have to prime the listeners so that we are recording this on the 20th of October. So we're still pre-election in the US, right? And a lot of people at this time and day are quite, not worried. Well, a lot of them are worried, but it's a lot of change about to happen, right? Either way, right? People are worried about the Trump election. People are also worried about Joe Biden being elected. And this is globally, right? This is very polarizing right now. So my question is, what should we do or not do when the market is at a high, right? It is right now, but people think about these outcomes, and you can make a case for both of them are not being good for stock markets. So what do you see? What do you say people should do?
I don't know if I'm going to answer in the right stylistic manner, but I would take an approach of analyzing each election outcome. There's 4 outcomes here, right? It's not about who wins the presidency, but it's about how many chambers of the Congress each party gets, and then what the main policies would come into effect, right? And it's such a bipolar election where the two parties have markedly different stance on a lot of key policies, right? So in particular, I'm sure I'm not answering this in the right style, but as a professional investor, it's more about analyzing each scenario and see what's the biggest risk to my portfolio. It's not about trying to predict the outcome or to make a return because I'm able to forecast the outcome. I think that is a very complex exercise, but you do need to be aware of which outcome would have the most risky impact on your portfolio. And so to give an example, from my perspective, I see a Democratic sweep of both chambers of the House, the Congress, will result in more antitrust, more stringent measures, antitrust behavior on big tech firms. And a lot of Democrats are even proposing to break up big tech firms like Facebook, right? So you know that some bigger volatilities are coming for big tech company stocks if this happens. But this is not something you can predict is sure to happen. It's just a probability thing. But however, you got to step back and say, hey, am I making too many concentrated investments? Is my portfolio having too many tech names, and should I consider more ways to diversify my risk, right? So it's more from that perspective. I would analyze it coldly, objectively, look at the risk, and just make an adjustment, but not in the anticipation of making a return based on my ability to predict these outcomes, right? It's all about risk to me.
And Joanne, for you, if we take it back to the more scientific level, right? What do you suggest people to, how do you keep in check? Because it's emotional, right? It's a very polarized, like I said, polarizing. No one knows what's happening. You can't trust the polls, as we know, through Brexit and the last election. So how do people stay calm in this?
I think firstly that exactly as you say, this is a very emotional time for everyone. I think I would echo what Freddy said, which is that this is the time to realize that any emotional time is not the right time to actually be making huge decisions about your portfolio. And so to try to be as calm and objective as possible when thinking about your investments, and try to divorce this from your emotionally subjective feelings. I mean, no matter what, large groups of people, are going to feel that this was not fair, that this was the wrong thing. So a lot of these subjective, ethical, moral, political feelings are going to be present in a large group of people, no matter what happens. So taking a step back, number one, being objective, number two, and then also acknowledging that you need that space. I think a lot of what we know now is that a lot of the world, as Freddy said, we don't want to sort of place too much weight on our ability to forecast, because we understand that that's not possible. Same way for behavioral scientists, we can't give people very specific advice about conditions. It's just not possible, and it's not responsible for us to do that. But what we can do to people is just remind them, first of all, be aware of yourself. Second of all, give yourself time. Give yourself space. I can't tell you exactly what the right decision is going to be, but I can tell you that you will need to calm down and take a breath. And that's, I think, the only thing that we can say for certain is that you will need to take a breath.
Yeah, no, great advice. So even if you might be listening to this.
But just to really pin it down, diversification.
That's good advice as well.
Absolutely.
So one builds onto the next, right? And I think, thank you both for being here today. I think this was super insightful. I know listeners always ask about, how to be better investors. And I think we gave them some great tips on how to do this. With that being said, Joanne, thank you so much for being here today.
Thank you for having me.
And Freddy, same for you.
Pleasure.
I will, we will be back with you in a few weeks. Thank you so much. That's it for the show this week. Thanks for listening. If If you like what you heard, subscribe and leave us a review. The reviews really help us, and we love reading your comments as well. In Your Best Interest is hosted by me, Philip Müller. We're produced by StashAway, and we're mixed by Mo Ramley. Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store. So you can start on your financial journey right now.